Many homeowners are sitting on a goldmine of equity, but aren't sure whether to choose a HELOC or a home equity loan. A home equity line of credit works very much like a credit card, where you only pay interest on the money you actually spend. This is the perfect tool for ongoing projects like a phased home renovation or as a safety net for emergency expenses. On the other hand, a home equity loan provides you with a single lump sum of cash at a fixed interest rate. This option is much better if you have a specific one-time cost, like consolidating high-interest debt into a single predictable payment. With a HELOC, your interest rate is usually variable, which means your monthly payment can change. As the market shifts in 2026, the home equity loan offers more stability because your payment remains exactly the same for the entire life of the second mortgage. You must remember that both options use your home as collateral, so having a clear repayment plan is absolutely essential for success.